Hi, JJ here with The Art of Value. Welcome. Well, today we're going to look at Warren Buffett and Charlie Munger again from the Berkshire Hathaway annual general meeting, where they had tens of thousands of people attend, as they do every year. So they have a long Q&A, a 6-hour Q&A session, and I've pulled some highlights from that. I've already made one video about this, reacting to some of what they said, and this time it's about opportunities, the opportunities they see ahead for Berkshire, and by extension for us as small investors, because he does talk about that. Warren Buffett does talk about that. So let's get into what they say about the opportunities in investing that they see in the years ahead.
I think value investors are going to have a harder time now that there's so many of them competing for a diminished bunch of opportunities. So my advice to value investors is to get used to making less.
Get used to making less. He makes the point there that there are a lot more value investors than there used to be, perhaps because of the fame of these two, Warren Buffett and Charlie Munger. I mean, there's about 50,000 people in that arena there. 50,000, as you assume, would be value investors. And it's true that value investing has become more popular, even though the returns haven't been so great, say, over the last decade or so. The last couple of years they have. It's sort of making a comeback. Growth investing took over, but he's being a little bit pessimistic there, saying that get used to making less. There have been other investors who've said that the next decade won't be so great for the stock market, like Stan Druckenmiller. I made a video about what he's saying recently, and I'll put a link in the description to that, where he said he wouldn't be surprised if the stock market's the same place as it is now or a few months ago in 10 years' time. So, and there are other ones like Howard Marks think we're back to normal. We're not in a huge bull market. So Charlie Munger thinks get used to not making as much going forward. What does Warren Buffett have to say about that?
Charlie has been telling me the same thing the whole time we've known each other. I mean, we get along wonderfully because...
But we are making less.
Yeah, well, but that mostly, I think, is because it's larger.
When we were younger.
We never thought we could manage $508 billion.
No,
or whatever. But I would argue that...
Buffett's making the point there that they're making less, which they are over time. They've still got a annual compounding rate of over 19% over more than 55 years it is now that they've been running money. Buffett makes the point that if you got less money to deal with, if you can make higher returns. I mean, the bigger the amount of money, dealing with $500 billion, as he said, the pool of opportunities is a lot smaller. They've only really got like 30 to 40 companies to choose from. You notice that the big bets they make are on huge mega cap, large cap companies, because they have to do that. It's not going to move the needle if they invest in a small cap or even a medium cap or even some of the large caps. They need these big deals on big companies. They have to buy 100% of a company and it still wouldn't move the needle. It's just a mathematical thing about the bigger the size of the wallet, as Buffett says, the lower the returns.
There's going to be plenty of opportunities. And part of the reason there are going to be plenty of opportunities, the tech doesn't make any difference or any of that. I mean, if you look at how the world's changed in the years since 1942 when I started, new things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things. And it's that...
What does he mean by other people doing dumb things? I think he's talking about psychology, market psychology of investors who buy high, sell low, and value investors traditionally buy low and wait for it, have that, not making an emotional purchase at the wrong time, don't get FOMO, etc. Let's see what else he has to say.
I would say that, well, the 58 years we've been running Berkshire,
58.
I would say there's been a great increase in the number of people doing dumb things, and they do big dumb things. And the reason they do it to some extent is because they can get money from other people so much easier than when we started.
And easier to get money.
I think that investing
to borrow
has
money
disappeared so much from this huge capitalistic market that anybody can play in, but that the big money is in selling other people ideas. It isn't outperforming.
He's talking about fund managers there, I think, selling people things that aren't a good deal or that aren't a good investments. A lot of fund managers doing that.
I think if you don't run too much money, which we do, But if you're running small amounts of money, I think the opportunities will be greater. But then Charlie and I have always differed on this subject. He likes to tell me how gloomy the world is, and I like to tell him we'll find something. And so far we've both been kind of right.
So there he talks about if you're having small amounts of money, you can do better in the market. And back in his early years when he was running millions rather than hundreds of billions, he did very well. He had 50% years compounding when he was running a fund. And he said that he could almost guarantee that if he was running a lot less money, because there are many more opportunities that the crowd isn't going for. He doesn't have to go for mega caps or whatever. He could go for these small, out-of-the-way companies where he analyzes and does very well, and that's what he did. So it's a different situation. Sometimes they get criticized, especially by, I've seen retail investors, growth investors during this last exuberant phase, criticize them for not putting more money to work. But the fact is they have to find those big deals of big companies, and they have to be a good price. So they're willing to wait, and that's the situation they're in now with running hundreds of billions of dollars. He does say at one point that they could buy something, a company worth 50, 60, up to $100 billion, but those deals just don't come along very often at a good price.
Will you budge an inch on that or not?
There is so much money now in the hands of so many smart people, all trying to outsmart one another and out-promote one another, getting more money out of other people. And it's a radically different world from the world we started in. And I suppose it will have its opportunities.
They're in the 90s, don't remember?
It's also going to have some unpleasant episodes.
But they're trying to outsmart each other in arenas that you don't have to play. I mean,
I'll just stop him there. What he's saying was you don't have to play in the arenas that other people are. There's the fund managers. You don't have to buy these mega cap stocks. Joel Greenblatt was another investor who started in special situations in smaller companies and did it incredibly well the same way. He kind of followed Buffett's early years, and he wrote a book about the special situations and these things that he found. He was very concentrated in 5 to 7 companies, stocks, and did very well. And that's what Buffett's talking about. There are opportunities where other people aren't playing, where you don't have to compete against all these smart people or trying to find these opportunities. That's the point he's making. I think it's a really good one. It's part of the reason why I'm more into small caps these days, sometimes medium, but mostly small, under $1 billion. Again, that's looking for quality compounders over time. I mean, there's more risk involved in very small companies, but there's potentially higher reward, really. If you look at something that's $50 billion or up, is it really going to 10x? Is it really going to 100x? When no company's ever got that far. I mean, they can in the future because of inflation and so forth, but really, he's talking about there are more opportunities if you have a small amount of money. That's where retail investors in particular actually can have an advantage over fund managers managing billions. By the way, if you're watching on YouTube and getting value out of this video so far, please hit that like button to help to spread it to more people. Thanks.
the world is overwhelmingly short-term focused. And if you go to an investor relations call, they're all trying to figure out how to fill out a sheet to show the earnings for the year. And the management is interested in feeding them expectations that will slightly be beaten. I mean, that is a world that's made to order for anybody that's trying to think about what you do that should work over 5 or 10 or 20 years.
Over and over again in this meeting, Buffett's talked about, he's brought up, I don't know what this company's going to look like. I don't know what this industry is going to look like in 5 or 10 years. And he said that I do think I know what Apple is going to look like in 5 to 10 years. So he's very long-term thinking, always thinking long-term. Do I know what this opportunity is 5 or 10 years down the line? Not next year or the next quarter even, but long-term.
I would love to be born today and go out with not too much money and hopefully turn it into a lot of money. And Charlie would too, actually. He just he would find something to do, I will just guarantee you. And it wouldn't be exactly the same as before, but he would have a big pile.
I would not like the thrill of losing my big pile into a small pile.
Well,
I like my big pile just the way it is.
Well, We agree on that, incidentally. Okay.
Yes, we do. You're one of the most extreme lovers of the big pile.
So I'd love to know your thoughts. What do you think about the opportunities for investing in the coming years? Do you think Warren and Charlie are right? Which one's right? They both have quite different views on that, with Charlie being a little bit more pessimistic and Warren not so much, but not so pessimistic if you have small amounts of money. So what do you think? Where do you think the opportunities are best in the coming years? What do you think the stock market's going to do? We just don't know, but what do you think? Let me know in the comments. Thanks. Okay, now there's more on opportunities, what they see for Berkshire and their huge cash pile, the opportunities that they see ahead, even in the position they're in, with a huge investments and huge amounts of capital to invest, but only when there are opportunities. What are they like? So this is what they had to say about that and the question.
At the 2010 Berkshire annual meeting, you said the one question that you would ask of the Berkshire CEO would be about the distribution of cash to shareholders as the Berkshire cash pile grows larger and larger. So let me ask that question. Right? Do you still feel confident of the future prospects for our over $100 billion in cash on hand, or are we getting closer to cash distributions?
100 billion.
If Berkshire shares are selling for less than we think they're worth, that could be a pretty big way to distribute cash. But what we'd really like to do is buy great businesses. If we could buy a company for $50 billion or $75 billion, $100 billion.
There, I'll just stop them there. What are you saying about buybacks? That's one way. If they don't see good deals around, they can buy back their own shares if the price is right. And over the last few years, they have seen that the price was right. Below what they saw as intrinsic values, they only do buybacks when they see that the company's trading for less than what they've worked out to be intrinsic value, which is not an exact figure, but I'm sure they do. They both do it, and they know after so many years of running Berkshire exactly, well, not exactly, but around about what it's worth, what they think it's worth. So they buy back their own shares. You know, that's just like a good investment in their own company. And as he said, but they prefer to have acquisitions. And they could have some big acquisitions, but there aren't just that number of opportunities around, not very often at the right price. Let's see what else he has to say about that.
We could do it. And we can do it, and our word's good. It's difficult with a public company because, in effect, if you bid on a company, you make the bid, and their shareholders vote months later, and you're giving an option. If we're good for it, and the other guy has a way to top you, or all kinds of things, they can get out of it, and you get paid 2% for that or 1% for that. That is not an appropriate price.
Saying buying public companies, big public companies, is a lot more difficult than private. So they prefer to do this. Is the problem of having so much money that they can't necessarily get a good deal or don't come along that's too competitive, and because they could buy $100 billion company if they wanted to. That's what he said. That's a massive company to buy. They tend to buy small percentages of big companies and increase it over time. But they said they could do a deal for 100% of some company.
It'd be easier to do with a private company, and there aren't very many that are big. On the other hand, there's nobody else that can quite make a deal like we can under the right circumstances. And there could be a situation where a number of very decent companies have got a very uncomfortable borrowing structure, and money comes due to them at the exact wrong time, and that's when they pick up a phone, as did Tiffany and Harley Davidson and you name it. I mean, a whole bunch of companies in 2008.
So he's talking about when there's an economic crisis, they kind of like that because companies that have taken on too much debt or whatever it is, they can't pay back what they've borrowed, and they get into distress, and they pick up the phone to Berkshire because they know Berkshire could buy them out sort of instantly. Buffett's well known. They're well known for making a decision within a few days, within a few hours even, and just have the money there ready to go, ready and waiting to pounce on those good opportunities. But they don't come along very often. Like the 2008 financial crisis was one, and so that's the time that they really actually like to buy.
That sort of thing will happen again, whether it results in us getting the calls or what the world is exactly at that time. But the one thing we know is that the number of phone calls that you can make at a time like that is very, very limited. And there can be good companies. They don't want to sell the company necessarily, but they just may need $5 or $10 or $20 billion, depending on what company you're talking about.
So they're saying they're asking for money, in distress, asking for money, And so Berkshire gets very good terms. That's how they get really good deals at the time when other companies are in distress. And Berkshire's a fortress with huge amounts of cash ready to invest in companies when they need it.
Can happen, and our own shareholders can be selling the stock too cheap, and we'll never do anything to make them sell it cheap, and we'll tell them the truth about what the business is. But if market circumstances result in us being able to buy in $50 billion of our own stock, we'll buy it.
I've heard him say that before too. A few years ago, I think it was 2020, 2021, he was basically saying that when they're buying back, he said he wouldn't advise any shareholders to sell, but if you do, we're happy to buy those shares off you. So pretty much Warren Buffett saying that the shares are cheap and we'll buy them off you if you were stupid enough to sell them. Or you have to sell them, because that's what sometimes in financial crisis, people sell for many reasons.
We'll see what the world holds. We don't have the opportunities we used to have, but we've got enough, and we're making money with the things we have. It isn't killing us to hold 130 billion of
130 billion.
bills at 5% plus bond equivalent yields, and everybody says, well, yields are going to go down in the future. I don't have the faintest idea.
5% is okay to hold cash at the moment.
You know, the prime rate was 21.5% in 1981 or 2, and people were worried that it was going to go totally spin out of control. And Volcker kept it from happening. But if Volcker hadn't been in there, who the hell knows what would have happened? So we're running Berkshire so that we'll do okay, and maybe we'll do a little bit better than okay.
What he means by we're doing okay and we'll do a little bit better than okay, the aim is to beat the market, beat the S&P 500, which is the market benchmark. So on average, it's been about 9%, I think, over a long period of time. So that's really what they're trying to do, is to continue to beat the market. They don't really have much hope of getting like 30, 40, 50, or maybe in a good year, but maybe not 50. But they, with so many investments they have and so much money, but they're just hoping to beat the market. And of course, it's probably likely that they will do that. When there's a bubble or an exuberant market, that's when Berkshire tends to underperform. And then after the inevitable crash after that is when they kind of catch up and overtake others who get into trouble. As I said at the beginning, I've made a previous video about this year's Berkshire AGM with Warren and Charlie, their Q&A, where they talked about Elon Musk, about EVs, about their big stake in Apple, the opportunity and criticism they got for that. And so if you want to go and see that, if you haven't seen that already, go here, and I'll put a link in the description as well for those on other platforms. Thanks for watching and listening to this one, and I'll see you next time.